Welcome to today's Luohan Academy webinar. It's my great pleasure to introduce Harvey to you. Cam is the J. Paustage Professor of Finance at the Fieldcroft School of Business at Duke University and also a research associate at UPenn. His work spans as a pricing, portfolio management, and most recently, decentralized finance. As you know, he served as the president of the American Finance Association in 2016. And before that, he was the editor of Journal of Finance, which is our flagship journal, for 6 years. But what I have learned from Cam over the years is that he does not only lead our academic thinking, but also really help us define what is finance, how finance evolves over time in practice. He is the director of research and the partner at research affiliates, overseeing more than 119 billion in investment products, and it serves as investment strategy advisor to Man Group, which is the world's largest publicly listed hedge fund provider. And he also most recently served as digital advisor and digital asset advisor to BlackRock. And he also cares a lot about promoting research, promoting ideas in finance to the public. His book, DeFi and the Future of Finance, which is also on my desk today, is now also on Cam's desk, is now a must read for anyone interested in the future of finance, where finance is headed. He has a weekly podcast. It's called Harvey Through the Noise, and he has his new Coursera course, which is also translated in Chinese about gold standard. So today, Cam is going to bring us to another frontier of finance, which is about tokenized gold, and that's based on his brand new paper, joined with Lin Chen of HKU, Daniel Rabadi of NUS, and Zhang Che of Tsinghua. I think Che is also in the audience. So, all right, without further ado, we're going to welcome Cam, and we will have a Q&A session towards the end of the seminar. But if you have any clarifying questions, feel free to jump in or raise your hand. So, Cam, take it away.
Okay, thank you for that introduction. And let me share screen. And please confirm that you can see this in full screen mode. Okay. Okay, I got the thumbs up. Okay, let me talk about tokenized gold. And you already mentioned my co-authors, Chen, Daniel, and Che, who actually is on the call as the second co-author to help answer some questions. So this paper is available on SSRN. It is a very early paper. We posted it December 31st, 2025. And that date is kind of interesting because you'll notice that some parts of the paper, some substantial parts of the paper came afterwards. I've been working on gold quite a while. So I discovered in doing some background research that there wasn't really that much academic work on gold other than the gold standard. And this is surprising to me because gold is a $34 trillion asset. Okay, so reflect on that. $34 trillion. Yet there isn't that much academic research on gold as kind of an investment or a medium of exchange. So I've also got a couple of Coursera's on gold that are listed here. My slides will be made available after the seminar to anybody who requests. So let me motivate a little bit of what's going on. And this is a recent graphic that I saw going across social media. Gold, of course, is the oldest financial asset. It was the basis of currencies until August 15th, 1971, when the US went off the gold standard. And this graphic is striking in that if we look at foreign central bank holdings of gold versus treasuries, it turns out that gold is more popular than treasuries. Now, it is the case that some of that increase is a result of the appreciation in the price of gold recently, which I'll have some comment on. It's also interesting, and I've got a couple of exhibits on this in terms of the holding of gold in terms of central banks. You can see that the U.S. is the dominant holder of gold, and that gold at market value is worth about $1.2 trillion. Interestingly, if you don't know this, the gold that the U.S. holds is accounted for on the U.S. balance sheet at $42 an ounce. So that's far away from the recent price. Okay, so why gold? So gold is a so-called hard currency. Fiat currencies are soft currencies. And there's a number of reasons people are interested in gold, this idea of inflation protection, diversification, and crisis hedge. And let me briefly go through these points. So, number one, gold has a very long track record. So, given it's the oldest financial asset. Indeed, in my paper, The Golden Dilemma, we actually have data on historical prices of goods in gold, like a loaf of bread in Nebuchadnezzar's time. So if you look at the price of gold over the last few years, the 1 ounce of gold would buy about 350 loaves. And today, that comes to about $8, which is approximately what I pay at my artisanal bakery for a nice loaf of bread. Obviously, Wonder Bread is cheaper, but it's not the same quality. So overall, the idea here is that the real return on gold is zero, which means over the long term, it hedges inflation. But gold is volatile. So since 1975, where we've got quality data, the volatility of gold is about the same as the S&P 500. So given that it's volatile, it is an unreliable short-term inflation hedge. In this graph here, you can see the real and nominal price of gold in blue and green, and then I graph that in black against the 10-year inflation, which is not volatile at all. And it just means that there could be long periods where gold underperforms inflation and long periods where gold outperforms inflation. And again, in the shorter term, it is not that reliable. So another important feature is not just to look at volatility, but to look at correlation. And this is 10-year correlations with equity returns. And notice that the average correlation is roughly zero. And it never really gets that high. So this is attractive. This is over a 10-year period. Need to beware over shorter periods, given the volatility of gold. It might be the case that the equity market goes down, and the price of gold goes down. In terms of the investment case in crisis or drawdowns, gold's track record is pretty good. In this graph, I look at the gold returns in 11 equity drawdowns recently, and gold is positive in 8 out of 11. And it is negative in 3, but the negatives are small compared to what happens in the stock market. So even though it didn't have a positive return, it actually continued to provide some diversification with a smaller negative return. So that's something to keep in mind. And again, recollect that the volatility of gold is very similar to the volatility of the S&P. And this is just another way to look at this, looking at average drawdowns and non-drawdowns, NBER recessions and expansions. And one thing that's very clear is that gold's return is on average positive when markets are down sharply or up. So it provides some level of protection, but you don't give a lot of that upside away. So this is in contrast to a hedging strategy, let's say with put options, where the carry is really super expensive. You might wonder about non-financial crises and whether gold is a safe haven, and it's not obvious what happens in like a world war or something like that. Indeed, every so often we find a treasure chest of gold coins that somebody buried as a safe haven, and the fact that we discover the treasure chest suggests that it failed as a safe haven. So before I launch into the paper, just quickly, the price of gold has gone up dramatically. It's up 47% over the last 12 months. What's going on? So as a bit of a background, the total gold above ground is 214,000 metric tons. Each metric ton is worth about $154 million. But that's not that much. So it's essentially all of the gold above ground would fill an Olympic-sized pool. So the supply is very inelastic. And for example, the price of gold has gone up dramatically, but the mining output has barely changed. So I just got the data for 2025, and it's almost identical to 2024, even though the price is up very sharply. So it's also the case that the mining supply, the new supply, is like inflation. And that inflation rate is low and steady. So for the last 10 years, it's about 1.7% per year. So the production is also decentralized. And this is very attractive in terms of decentralized finance. So what I mean by that is that many countries produce gold. The largest producer is China. But you can see from this chart that there's many other countries that are close. So this means that no one country can control supply. So financialization is really the topic of what we'll do today. And the first financialization is the introduction of the gold ETFs. And on this graph, you can see the impact of the gold ETF. And what's really interesting to me, and I document this in my papers, the green is a regression fit based upon the flows going into the ETF. So after 2004, when GLD was introduced as an ETF, there's a very tight correlation between the ETF flows and the price of gold. That correlation is 0.9 until recently. Look at the far right, and you can see a divergence. So the flows no longer account for kind of the lockstep movement in the price of gold. Okay, so why? This breakdown begins in 2022. In 2022, in February, Russia reinvaded Ukraine, and the SWIFT system was used as a sanction mechanism. So the US dollar was effectively weaponized. And there's a scramble to seek out alternatives. And indeed, China, I believe, noticed this. So this is, again, the central bank accumulation. And you can see that the US has the largest amount of gold. So in terms of buying recently, the de-dollarizing countries are leading the buying. So the PBOC is the #1 buyer over the last 10 years in what I call the official data. We don't exactly know how much gold China holds. It is also the case that China is far behind the US in total supply and especially in per capita supply. So again, given that they're buying, there's a long way to go if there is a goal of achieving parity. And then number 5, there is doubt about the dollar as a reserve currency of the future. So the U.S. debt is now 39 trillion. The deficits are structural, and a number of central banks are thinking this is the time to diversify holdings. Okay, so why tokenize gold? So the idea here, and it's a provocative idea, is that this could be like an alternative store of value or medium of exchange in a fiat competitor. So we tokenize for ease of digital use. We've got extreme divisibility that doesn't exist for ETFs or for physical gold. The tokenization is available 24/7, 365, and there's other features I'll talk about. But the idea of this is, and really this is an open question, is it possible that we could have an opt-in return to a gold standard without any central bank intervention? That is a provocative idea. So what I'd like to do is to kind of give you a preview. And again, this paper is very preliminary, and what I'll present is mainly descriptive, but you can see, hopefully in the presentation, that there are some provocative ideas. So the market cap right now of tokenized gold is fairly modest. So it's 6.1 billion. And it turns out that there are 2 main tokens. And I'll talk about these tokens in detail. So one is XAUT, which is Tether's gold token. And just by the way, Tether also has another stablecoin, a fiat-backed stablecoin, which is the largest market cap stablecoin. And indeed, in terms of the Tether reserves, they hold gold as part of their reserves for the fiat stablecoin, making Tether one of the largest gold holders in the world. The other is the Paxos gold, and it's slightly smaller overall, but put these together 95% of the capitalization. So the volume of trading has been growing. I will show you that. The amount of gold on chain is about 1.2 million troy ounces. Again, this is small compared to overall gold, but what we need to notice is the direction. And indeed, this is important in finance to look at things early on and notice the vector. And this is what we've tried to stake out. This is a very early look at a fairly, what many consider a niche asset, but given gold's overall role in the world, something that we should pay attention to. There are also derivatives on these gold tokens that we need to take notice of. The size of this market is growing rapidly and is expected to continue to grow rapidly. So Wintermute suggests that in 2026, that 6.1 will more than double. And fairly soon, we will see the case that the gold tokens will overtake the ETFs. Okay, so in terms of our research question, even though this might appear like a niche asset, niche assets are often illiquid. And when something is illiquid, you need to be really careful. So we will argue that we don't see issues with illiquidity, and we will show that tokenized gold closely tracks traditional benchmarks. We will also look at shocks And again, if something is illiquid, it might not be available or very expensive to trade in periods of stress. And we've got analysis of a number of stress periods. And then number 3 is embedding in the financial system. And this is something that is very interesting in terms of what decentralized finance can do. So the tokenized gold will be a centralized token. So that means a company is issuing it. So Tether and Circle issue fiat-based stablecoins. Those are centralized because it depends on a company. But the token itself is used in decentralized finance. So it turns out that tokenization enables things that are not possible with the physical gold. So things like earning a yield, and that could be done via staking, or it could be done via lending. And I'll show you some data on that. So effectively, your gold is put to work. So if you're just holding physical gold, it's got like 2 levels of negative returns. Number 1, inflation. And as I mentioned, over the very long term, it covers inflation, but over the shorter term, it might not. But also the storage cost. Whereas with tokenized gold, we can actually earn some yield on it. And you might think, well, if I have an ETF, I can earn some yield by lending it out. Well, that yield is trivial. So it may be 10 to 15 basis points on an annualized basis. So again, there's some attractiveness to looking at tokenized gold. So we've got the complete history. We'll focus on these 2 tokens, the PAXG and XAUT. So Pax Gold is actually based in the U.S. Paxos Trust is based in New York, and it is regulated by the New York Department of Financial Services. It is available on a number of blockchains, including Ethereum and Solana. Tether is not based in the U.S. It's actually regulated in Switzerland, and it's not available on U.S. exchanges directly. So how does it work? So 1 token is 1 troy ounce in both Tether and the Paxos Gold. The Paxos Gold, which most of the presentation really focuses on, is vaulted by Brinks in London. So Brinks is this company that's been in business over 100 years, has got a stellar reputation for security. The third bullet is that Paxos is regulated by the New York Department of Financial Service. And this is a regulator that's known for being very stringent. So to actually locate in New York to be regulated by the NYDFS is basically signaling that you're willing to be subject to stringent regulations. So number 4 is fascinating to me, and it's the idea of bailment. So let me talk about a situation that is, until recently, plagued stablecoins, and in particular, the fiat stablecoins. So think of Circle. So Circle issues USDC, and to get the token, you send some fiat to Circle, and they mint some USDC, and then they take your fiat and put it in reserve. And that reserve could be attested. You can actually see the reserve. It's a money market fund managed by BlackRock. And the reserves might be equal or even greater than the amount of token liabilities that Circle has. The problem is that Circle might do something else. It might make a bad acquisition. It might borrow money. And it turns out that if there was a problem, the token holders are just another creditor. So there's credit risk in USDC and Tether. However, the Genius Act that was passed in December fixes that. And what it does is it ensures that the token holders for USDC are at the front of the line in terms of getting back their money. So this does not apply to Tether. Tether is offshore, the Tether fiat, but the Genius Act doesn't apply to gold. So what Paxos has done is something called bailment. And bailment means that when you actually send your money to buy a gold token, that you actually have ownership of a bar, a particular bar in London with a serial number. That means if the company Paxos goes bankrupt, no big deal, because you have ownership of the actual gold bar. It's a fascinating idea that delivers a level of legal protection. Also, interestingly, there's no storage fee. This is available on the main exchanges like Coinbase and Kraken. So Tether Gold, on the other hand, doesn't have bailment. It's not regulated in the US. It is stored in a Swiss nuclear-proof bunker. Actually, I didn't know that there are 250,000 of these bunkers in Switzerland. So this one is put to use. And there's also a redemption fee. It's not traded onshore. So let's kind of go through here, comparing physical gold, the gold ETF, COMEX futures, that's another type of financialization, and the gold tokens. So one thing I want you to notice is the trading hours. So ETF is just standard stock trading hours. COMEX is 23 hours a day, but only Monday through Friday. The settlement for the gold token is near instant, 1 to 12 seconds, depending on the blockchain that you're dealing with. And also I mentioned this divisibility. So the smallest practical grain of gold is about 50 milligrams, and that's worth $8. So if you're using physical gold, the smallest is $8. And for the ETF, it's 1/100th of a share. Whereas the token is divisible to an extreme degree. So you can do micro transactions of like a trillionth of a cent in terms of value. So can we use physical gold ETFs or COMEX futures for sort of DeFi purposes? No. And again, we want to do this to get yield. The gold ETFs here, I'd say less than 40 basis points, which is correct. But remember, you split that yield with your broker. So that's where maybe you get 15 basis points on an annual basis. Whereas the tokenized gold, you get yield. Storage costs for physical gold are high. The ETFs charge 40 basis points a year, whereas the storage costs for the gold tokens are zero. Okay, so let's talk about benchmarks. Again, this is a fairly new market. It's reasonable to suspect that there be substantial deviations. And the graph to the left just looks at the price of gold with the futures, the spot, and the two tokens, and you can't tell. It just looks like the same. They're overlapping. On On the right-hand side, I just focus on spot gold and PAX-G. And you can see there's some deviations, but notice that the deviations are often positive. So the premium for PAX-G is often, or usually, positive. Okay, so that's going to be interesting, and I'm going to return to that. And this is just tracking error. So this is a standard deviation of the token return minus the spot return. So the so-called tracking error. What I want you to notice from this graph is that the tracking error is generally decreasing. We do it by day of the week, but the darker bar is 2025. Okay, so this is just what happens during the day. And again, this is the premium. And this is the premium. Blue is the PAX-G, and then the Tether. Notice Tether's token doesn't really have a premium over spot, where the PAX-G token does have a premium. So they're highly correlated, unsurprisingly, and maybe unsurprisingly, trading volume is the highest during kind of the New York Open and the London trading hours. That's in purple, and you can see that it's highest, but it's still there's volume at other points during the day. And there's just another representation. And what's kind of interesting to me, we've kind of highlighted those hours, the London-New York overlap. Obviously, trading is lower on the weekend. But notice that there is some trading on the weekend that we might consider substantial. This is just what the average transfer size looks like. Tether and PAX-G, very similar in terms of their distribution, and like the overlap is pretty clear. This is the average transaction size. It has increased in 2025, and this is not just due to the price of gold going up in 2025. You can see that the transaction size on average goes from 0.15 an ounce to half an ounce. And this is largely a result of institutions coming in and taking a larger share of the tokenized gold market. We can also see this in the ownership concentration. So with the top 10 addresses holding 41% of the supply. And again, this is something that has happened recently when institutions are coming in and participating in this market. This is kind of the distribution of centralized versus decentralized. And Binance is the largest in terms of average daily volume. However, if you look at the decentralized exchanges that are doing tokenized gold, you can see that the decentralized exchanges are about half of the overall trading volume. So this is in contrast to fiat stablecoins, where decentralized exchange is much smaller in terms of a ratio to centralized exchanges. And this is just the number of addresses, and you can see, especially in 2025, a substantial growth in the number of active addresses. Okay, so what about reaction to news? Remember, I said at the beginning that there could be an issue that in a period of stress, if the market falls apart and decouples from the spot market, then the tokenized gold fails to serve an important purpose. So this is from kind of the first version of the paper that we published in December 2025. And what we did is we looked at 5 different news releases that were kind of substantial releases that moved markets, and we looked at the futures versus the PAXG token, and noticed that the token was very close. It reacted very similarly to the futures. Notice the second one, and it turned out that the second one was a Fed leak, and it happened on a Sunday. And what's interesting with this one is the futures market not available. So the tokenized gold actually moved, and then we had to wait until the futures markets opened, and then they effectively adjusted to the price that was already in the market via the tokenized gold. So again, we post this paper in December, and we are gifted with some out of sample events that are much more substantial than any of these 5 on this graphic. So let me go through these events. So number 1 is we call it a stress test, and this is January 29th to 30th, where there's a 10 standard deviation move in the price of gold. So gold went to more than $5,600 and then dropped by nearly $1,000. Okay, so this is interesting. In the first graph, in black, you've got the spot, and then I've got the PAX in blue and Tether in orange. But notice what happens, that this crash happened on Thursday and Friday, and then the traditional markets closed. And then you see this long period where we've only got the tokenized gold and there's no black. And then markets reopen, and the price adjusts to where the tokenized gold is. So there's a number of things to notice here. So first, notice the volatility is nowhere near what we experience when the traditional markets are open. So it's very smooth. And this is the case in other markets also. And then the second graph is the premium of the PAXG versus the Tether. And notice it's positive, and substantially positive through this period. And then the bottom graph is the Paxos token minus spot. And again, there is a premium. And we can think of this as a convenience premium. So it's a convenience premium, especially for Paxos. It's got 24/7 liquidity. Indeed, both have 24/7 liquidity, the Tether Gold and the Paxos Gold. But to me, the main difference is the bailment and the regulation that protects the holders of the Paxos token, whereas Tether is essentially unregulated. Okay, so the second out-of-sample exercise is the Israel-U.S. strike on Iran. That happens at 1:23 a.m. Eastern Time. So is first broke in the Israeli news, and the market is closed when this happens. So you can see in the first graph, again, I've got in blue Paxos, orange the Tether token. So there's this period after the market closed where there's no action in terms of the spot, and then the bombing starts, and all we've got is the tokenized gold. In contrast to the previous graphic, you can see that there is substantial movement in prices during this period. So we're seeing from 5,500 to 5,250, and then again when markets open, the prices adjust. Again, notice the premium. So the premium of Paxos over Tether, number one, is striking. And then also the premium of Paxos over the spot gold. And again, this is detailed below also. Okay. So what about DeFi integration? This is relatively new. So this is just the aggregate DEX activity. So you can see very small from 22 through to the beginning of 2025. And then it has substantially increased. So this is mainly stablecoin, fiat stablecoin to spot gold activity. And this is just the distribution of DeFi integration. So this liquidity pool, aggregators, lending collateral, and bridges. And I've got data on all four of these categories. This is the borrow rate on average, 4.03%. So again, we don't have an equivalent of earning a yield like that for either ETFs or physical gold. And then we've also got, this is just on the right-hand side, some Aave data. And this is, again, very early on. And we can see that tokenized gold being incorporated into the DeFi ecosystem. And this is just gives you an idea. This just gives you an idea of the swap activity in terms of major cryptos versus stable coins. And you can see the blue bar on the right is the gold to stable fiat stable coins is dominant, but again, if you look at the orange bar and the green bar, put those together, and that is like major cryptos or other alternative tokens, it's about the same sort of volume. And this is what I mentioned earlier in terms of the types of investors. So we've got retail investors in this market. Initially, the market was dominated by retail investors. Now we've got investors that are institutional. There's a wide geographic dispersion of interest, and this is just for PaxG distribution of web traffic, and essentially this is. I guess the cross-chain activity also to be complete. But the bottom line here is that this is not an illiquid asset anymore. Maybe it was illiquid in 2022 and 2023, though you don't really see a lot of evidence of that. It is fairly liquid. So to end up, because I want time for questions here, there's many other ideas floating around. Indeed, there is a company, and this is a fascinating idea, that are tokenizing in-ground reserves. Okay, so the idea is that, well, why even spend the substantial money to mine the gold when we could essentially tokenize that? So instead of having gold bars in a Brinks vault, we've got the gold in the ground. So obviously there's a haircut for this because it's expensive to mine the gold to actually get it. But this is a fascinating idea to actually have the tokenized gold in the ground. I've talked about yield generation, and again, this is just the beginning where we can actually earn money on the tokenized gold. And again, there are advantages in terms of this divisibility and, of course, the potential for being a medium of exchange. So let me conclude. So I think that our preliminary evidence is consistent with the hypothesis that tokenized gold is has got sufficient liquidity. It closely tracks traditional metrics, and it also allows for off-hours price discovery. That's number one. Number two, we have these out-of-sample episodes, and indeed we've had three. I showed you two. And in these episodes, the gold tokens closely track the spot gold and, again, provide price discovery when traditional markets, are closed. And then number three is this idea of integration into the ecosystem of decentralized finance, which provides interoperability in terms of one thing. It provides the ability to earn yield, which is another thing. And this is, I think, we're right at the very beginning of this. And importantly, it also provides the ability to do transactions. So we're not there yet. And let me just close with the idea that I put at the beginning of the presentation. So most of the investment in gold tokens is mainly for speculation and maybe store of value, so you actually get yield. And with traditional gold investments, you don't. So you get the gold appreciation plus yield. What we're not there yet on is gold as kind of a mechanism for exchange. So the idea at the beginning of the talk is that this could be a competitor to fiat. And I think a competitor is a good idea. Indeed, it would discipline the central banks having this competitor. And again, the central banks need not to be involved. This is just a different type of stable coin. So it's a provocative idea that after so many years from 1971, that we face the possibility of a de facto return to a type of gold standard. So at this point, I'll take questions.
Thank you, Ken, for this super insightful educational presentation. And so I already saw some questions coming up, but maybe let me take the liberty to ask the first question. And I think this is related to the broad landscape of tokenization, because it's such a hard yet also new field. And I completely buy the idea that eventually, right, there is the potential for tokenized gold to join the family of money as store value, medium of change. But I also wonder, can you give us a little bit more guidance fitting tokenized gold into the bigger family of tokenized assets like tokenized deposits, tokenized money market mutual funds, or maybe because of the Junior Act and Stable Act, eventually we can have safer and safer tokenized dollar, which is dollar stablecoins. So maybe there will be some pecking order going forward or some competitive landscape in terms of tokenized gold is specializing some markets, while other tokenized assets specializing other markets. So could you give us a little bit more highlight about this big picture? I think it's going to benefit audience as well.
Yeah, sure. So one thing I kind of skipped over, there was a table with a lot of numbers. where we actually look at the tracking errors across different tokenized assets. So, not surprisingly, tracking error for a fiat stablecoin is very low. And that's because the volatility is very low. And then we calculate tracking errors for tokenized gold at about 20 basis points. If you look at the tracking errors for tokenized stocks, they're about 10 times that. So more like 200 basis points. So very, very large. And again, this is mainly because of illiquidity, in my opinion. But your point is a general point, and I'm very glad that you're the host of this meeting, given that you're a researcher with important research on stablecoins. And it's a reasonable question as to where this fits. So my vision of the future, which is actually in my book, is that we have been subject to kind of a monopoly situation with fiat currency for a long time. So the US dollar is legal tender. It's the only legal tender in the US. And that gives the US government the ability to inflate, which it has done. And that's just a tax. So currency, fiat currency is just used as a taxation mechanism. So in the future, we will have other ways to pay for things. And an obvious alternative is to pay in gold. But it need not be gold. It could be other tokenized assets. So it could be tokenized stock. It could be tokenized land. So we will have a choice as to what to pay in. Now, if you have tokenized, let's say, Amazon stock, that's highly volatile. So that stock is as volatile as Bitcoin. So maybe that is not as attractive. I mentioned that tokenized gold has about the same volatility as the S&P 500. That actually works against having gold as a transaction mechanism because that's volatile. And I think that people are attracted to lower volatility assets. Before 1971, gold wasn't particularly volatile, but now it actually is. So again, I see tokenized gold, given its history, so given the long history of the gold standard, given the track record of holding its value over a very long time, gold will be at the top of the list. Maybe not the number one, but at the top of the list. But again, people can pay with whatever they want to pay with. So if you have a tokenized silver or platinum or Apple stock, it doesn't really matter. You can choose at the grocery checkout what you want to pay in. And if the grocery store doesn't want your tokenized silver, but will take tokenized gold, then it'll be swapped instantly at the best possible rate. And it will be as easy as tapping your phone. That's where we're headed. It's obvious to me. And it gives consumers the choice. And again, it disciplines the central banks.
Yeah, I like the idea of having this nice middle ground. So you're not going to subject to inflation, but not as volatile as tokenized Amazon stocks.
Yeah.
Long has a question. Yes, please.
Oh, yes, Cam. It's always great to hear your talk. And I guess it's super interesting. And essentially, it says that tokenized gold is a different animal. And so what? That's the key issue here. And I have several short questions. The first question is let's compare as the medium of exchange, let's compare US dollars, Bitcoin, and gold. Now, some of the claim is that gold can be used to avoid diversify risk or its volatility, but neither of them is the strong show thus far. If we look at the especially with the quick rise of the gold price. And recently, when market panic, it really goes actually to US dollars more than other stuff. So as the medium of exchange stability or diversification of risk is not as clear. So I would like to hear a bit more on you on this. As medium of exchange, what's exactly the advantage? The second question is if we want to appreciate the how mainstream is this going to be. Let's ask questions. What are the most valuable use cases for if we use the tokenized token? When hearing what your talk, I've been thinking about, is it reserve? Should the central banks take the real world gold or the tokenized gold? It seems to me that central banks do not buy and take the real world gold. I'm not sure. The second case I've been thinking about maybe should people take the ETF gold or just this gold tokenized gold? This seems to be a little bit better. Is that the main use case? Or taking this as less ETF, but sometimes can be used as payment. But none of them strike me as the mainstream. That's going to be a lot of people use it. I'm not sure about this. So I would like to appreciate your comment. The third question is, you've been talking about gold. How is your comment on other crypto assets like the Bitcoin or stuff? Bitcoin, I think it seems to be losing its role as the medium of exchange. Do you agree with that? You seems to imply that gold is the most likely to still have that hope. And finally, $1 trillion question: do you have a sense of where gold price will be in the future, or have no sense? Thank you very much.
Okay, so I'm going to combine question number 1 and 3. So the US dollar is nowhere near to being replaced. It is the reserve currency, and
Right.
there's no country that's close. My paper called Understanding Gold on SSRN, which is linked in the presentation, goes through the details of a reserve currency and the characteristics. And there's no country that's close, and probably in the near future, not close. As for Bitcoin, so that's kind of like question 1 and 3. Bitcoin has got a very short history. People claim that it's like gold, and there are some similarities. So number 1, it's decentralized production. Number 2, the inflation rate on new Bitcoin is about 1% right now, and gold is 1.7%. But the comparisons stop there. I've got another paper called Gold and Bitcoin that goes through a detailed comparison of gold and Bitcoin. So let me just preview one thing. Gold is actually used for stuff. So more than half of gold is for artistic jewelry and things like that.
Right.
5% in technology. Your smartphone has got gold in it. Dentistry, where Bitcoin has no tangible value. It's got intangible value. So my paper actually goes through a scenario where there's a 51% attack on the Bitcoin blockchain, and I actually cost it out. And it's feasible to do. And that drives the price of Bitcoin to zero. So the price of gold is not going to zero. It does face some other risks, and I go through all of the risks of gold. So I would recommend this self-promotion of my paper, Gold and Bitcoin. So as for this talk in the media, the gold and Bitcoin are moving in different directions, or, gold dropped by 5% and it's not providing a hedge in the Iran crisis. No. Again, this is a volatile asset. It is as volatile as the S&P 500, and you don't expect for every single event it to move in lockstep. So this is highly stochastic, and in the bottom line, over the last 12 months, gold is up 47%. So, yes, it might have dropped from the peak of $5,600, but if you're a buyer at 5,600, then you bought high and you're a loser. So, again, we need to be careful on this. In terms of your final question on the use case, so think of the central banks. They hold gold in reserve. The ETFs are mainly for longer term holders for gold. I see the gold tokenization as kind of short term holders that are using it for transactions. We're not there yet, as I said, just like we're not there for fiat stablecoins. So fiat stablecoins are mainly used to buy other cryptos for trading. So we're not there yet, but the question in finance is always about the future. So what distinguishes finance from accounting? Accounting is important in that we understand the current state and the past, and finance is all about the future. And I guess what I'm saying here is that we've solved a number of problems, in particular the Paxos token. And just by the way, I have no conflicts of interest with Paxos or Tether. So it solved some problems, in particular this bailment issue gives strong legal protection and the possibility of earning yield. So again, it's kind of, it's like if you're holding Ethereum, why would you not stake it to earn that yield? So I do think that the tokenized gold will provide competition for the ETFs because you get the price appreciation in gold,
right,
and you get a yield. So I think that is so we'll see what happens there. As for the central banks, they'll just hold the physical. So one interesting idea that's not in the paper is that the centralized banks might actually, or the central banks and centralized banks, regular commercial banks, they might get into this business. So just like the commercial banks all have stablecoin fiat initiatives, this might be something that they're interested in. Indeed, a number of states are interested in this technology and have contacted me to give testimony to their committees. So there's many possibilities here. And I guess our job as finance academics is to sketch a vision of the possible future and the advantages that come along with this. And I see considerable advantages. And I'm not saying that we're going back to the gold standard. I didn't say that. I said that it would be an alternative. And if somebody wants to choose to just hold gold in terms of their value, that's fine. They can do that. They're free to do that. And then they can pay in gold. That is fine. It is kind of an opt-in. So those are good questions. I appreciate them.
Got it. Thank you.
Thank you for the great discussion. There is a question from the chat. I think we can all see, but I'm going to read it. And from Hi, excluding all policy and legal interfaces under the premise that blockchain is bound to operate normally forever, gold will have a certain permanent impact on the global monetary system and financial regulation. So how can only be changed in the global monetary system and what in financial regulation? How exactly can one make the fastest and best changes? What can never be changed in the global monetary system or in financial regulation? What are the specific root causes of each? And relatedly, excluding all policy and legal interfaces under the premise that blockchain is definitely operating normally, how can gold be completely removed from the blockchain as quickly as possible and never be able to be released on the blockchain? Yeah.
Oh, wow. So that that would take a long
Two
time to answer. But
big
just
questions.
this idea, actually, let me kind of go through the mechanics of how this actually works. And let me, and I think this will largely answer the question. And the example is a fiat stable coin. So the way that stablecoin works is that I send my US dollars to Circle, and I'm simplifying. Let's say I send 100 US dollars to Circle. Circle creates via a smart contract, let's say on the Ethereum blockchain, but it could be on Solana blockchain or another blockchain. They create some tokens. They create 100 USDC. So that is from a smart contract, there is a transaction whereby those 100 are sent to my address. And then I can use the USDC, or at some point, I could send those tokens back to the smart contract and get my $100 back. When I send those tokens back, they are burned. So they're destroyed. They cannot be used again. So this idea, and we could do the same thing with gold. So I send some money to Paxos, so it could be a fiat currency. They take that money and buy a gold bar and store it in a Brinks vault. They mint a token, and then if I want to repatriate, let's say US dollars, I send the token back to them. They sell the gold, the physical gold, and then burn my token. So this idea of gold remaining forever on a blockchain, no. Just like dollars don't remain forever on a blockchain. The token, once it's redeemed, is destroyed. So this is important. I don't know if you saw this. I think it was PayPal, who also has a stable coin, made a mistake. This happened during my teaching, and they mistakenly issued 15 trillion of their stable coin, which you just can't do, but you can. Because it's just an algorithm, and then they immediately took the 15 trillion and burned them. So again, it was a mistake, and then they corrected the mistake. So the gold does not live forever on a blockchain. So that said, given that the token is a result of a smart contract, there could be some risk of a smart contract exploit. So this is something that we need to worry about in any situation where you're using a smart contract, that there historically have been vulnerabilities that have been found. So this is not risk-free. And for users, you need to balance the risk versus the expected benefit. And the expected benefits are very substantial. And again, this paper is just part of a broader literature on tokenization, in particular stablecoins. So I consider the gold token just to be another type of stablecoin. And again, I don't want to give the impression that this is risk-free. It definitely isn't. And let me also say that holding physical gold is not risk-free either. You can be robbed. Or your gold is in the vault of a bank and the bank goes under. Then you're just another creditor. So there's really nothing that's risk-free. But again, we weigh the benefits against the costs. And this idea that we could actually use gold for regular transactions is very attractive. Again, you can't do that with physical gold or ETFs. So the smallest gold coin is very valuable. You can't use it. It's not going to be accepted. And the gold coin, just by the way, people don't know if it's fake. You don't know what the purity of the gold is. Whereas the gold in the Brinks vault is a certified bar where we've got certified purity. It's got a serial number on it. Again, it is centralized, some trust is involved. This is not pure decentralized finance because there is an intermediary, Paxos or Tether, and we need to trust them to a certain degree. We can have attestations, but still, the attestation is not a continuous attestation. So hopefully that comes close to answering the question.
Thank you, Cam. So let's perhaps take the final question and also in the chat from Chen Siying. If tokenized gold is widely used as DeFi collateral, could a large price shock trigger liquidation cascades due to limited on-chain liquidity? And number two, could your data be used to model Ethereum gas fees as a dynamic arbitrage threshold that widens the non-arbitrage bound during congestion and increases tracking error? Yes.
Yeah. So the first question, could there be a liquidation cascade? Yes. But the risk of that is way smaller than, let's say, Ether or Bitcoin. And the reason is the volatility of gold is relatively low compared to other cryptos. So think of the volatility of gold at 15% annualized, Bitcoin 50%, Ether 60 to 70%. So it's much more likely to get some sort of cascade. Of course, the margins would be impacted by the differential in volatility. So I guess what I'm saying is this is less volatile, number one. It is much more liquid. And when I say liquid, I mean liquid both spot, futures, ETF, and tokenized. You need to look at the total market. Whereas these other cryptos like Ether and Bitcoin is very narrow. Everything is just based upon either decentralized or centralized exchanges. There's no equivalent to physical Bitcoin. There are futures, but there's no equivalent to the physical. So I think that the answer is yes, but this is an issue with all cryptos, and indeed not just crypto. This is just an issue in finance in general, that you can have a liquidation cascade. And then the second question about the arbitration potentially modeling the gas fees. So this is an important issue that, and this was pointed out to me at a recent crypto conference. That we're talking about Solana versus the Ethereum blockchain, and Solana's blockchain have been down multiple times, or just like no activity. But Ethereum has always been up, so it's never gone down. But if your gas fees are $1,000 a transaction, it is effectively down. And that happened, right? So that happened in October. So so this idea of kind of modeling the gas fees is I think a very interesting research area. Could it be that these tokenized assets provide an opportunity to say something about equilibrium gas fees? Maybe. It wouldn't just be gold. You'd have to look at all of the tokenized assets. But it is a possibility, and I think it's an interesting area of research.
Thank you. This is super interesting. I think the number one keyword I heard from this very insightful presentation is choice. Like everybody talks about, I mean, we complain about fiat and we hate government controlling supply of money, but at the same time, we also hate volatility. And I think the key point of the talk today is to help us find a middle ground and expand the choice set as we do portfolio choice. I mean, going back to the core business of any financial economist. And now we have a new path for us to explore. This is super, super interesting. So, Cam, before we conclude, do you have anything before we, yes, finally end the talk? And feel free.
Yeah, so I agree with you that choice is important. And this whole initiative of decentralized finance is about giving a choice. But it's more than that. It is about reducing the middle layer, and it is about reducing the influence of monopolies and duopolies in our economy. So I consider it not just choice, but competition. And competition that is really needed. And Exhibit A is the average savings deposit rate at banks in the US. And it is about 40 basis points annualized. And if you go to the too big to fail banks, you're lucky to get 1 or 2 basis points. So again, what we're doing in decentralized finance is providing competition. So the fiat stablecoins, you're not going to get 1 basis point. You're going to get a reasonable rate of return, which is going to be like 3% or greater. And that can even be magnified. So this is much needed competition for the commercial banks, and it's much needed competition for the central banks.
For sure,
also.
for sure.
So I think that this idea of decentralized finance and providing financial democracy, and democracy, a key component, is choice and also at competition. So there you go.
Yes. Choice. Whenever we have more choices, there is more competition, and it's gonna help us better battle with monopoly or anyone who has too much power. Thank you so much, Ken. This is super interesting and educational. Please feel free to follow up with Ken if you have any question, any follow-up thoughts, and as Ken mentioned earlier, and Ken also has this weekly podcast and also Coursera course, and there will be a lot of food for thoughts. So let's give Cam another round of applause, and please stay tuned for
and my co-author Cha is actually
yes.
here. Yeah.
Thank you everyone for participating today.